Leonard Industries wishes to prepare a pro forma balance sheet for December 31st, 20x3. The firm expects 20x3 sales to total 3 million. The following information has been gathered. A minimum cash balance of 50k is desired. Marketable securities are expected to remain unchanged. Accounts receivable represent 10% of sales. Inventories represent 12% of sales. A new machine costing 90k will be acquired during 20x3. Total depreciation for the year will be 32k. Accounts payable represent 14% of sales. Accrual, other current liabilities, long-term debts, and common stock are expected to remain unchanged. The firm's net profit margin is 4%, and it expects to pay out 70k in cash dividends during 20x3. The December 31st, 20x2, the balance sheet is as follows. Balance sheet for Leonard Industry as at December 31st, 20x2. Please spend some time to look at it. Use the judgmental approach to prepare a pro forma balance sheet dated December 31st, 20x3 for Leonard Industry. Assumption for this question. We assume that the accrual, current liabilities, etc. remain unchanged. The above assumption may not always be the same. Pro forma balance sheet for December 31st, 20x3. From point number 1 in question, a minimum cash balance of 50k is desired. So here will be 50,000. Marketable securities are expected to remain unchanged from the previous year to the new year. From X2 to X3 remain unchanged at 15,000. So here remain unchanged, same as the X2. Accounts receivable represents 10% of the sales. So here, simply 10% times the new year, the sales figures, 3 million sales figure for the new year, right? So it's 300k. Inventory represents 12% of the sales figure. So it simply times 3 million again, give you 360. Add up total together is 725k. Any questions so far? The net fixed assets here will be 600k for the balance sheet and equity X2. Look at point number 5. You have a new machine that costs 90k, and you minus off the total depreciation for the year is 32k. So you get 658. So add up these two, you have a total of 1.383k. Any questions so far? The accounts payable here, you know that from point number 6 is 14% of the sales figure. Okay, so 40% represents 40% of the sales figure. So it's 14% times 3 million give you 420k. Accrual remain unchanged from point number 7. Other current liabilities remain unchanged from point number 7. So add up together here, 420. Give a while. 420 plus 60 plus 30 give you 510. Long-term debts remain unchanged from point number 7, 3750. Okay, so you take from the figures from X2. Common stock remain unchanged, okay, at 200k. So from the same figure from the balance sheet. Retained earnings, you take 3 million. Okay, the profit margin is 4%, so this will be find the net profit margin. You plus the last this figure is from the 20x2 balance sheet, minus out the cash dividends give out, okay, 70k, so it give you 270,000. And we know this figure has to balance, okay, with the other one. So we know there's 1383. Okay, this is a balance sheet, so definitely we have the balance with the total assets. Okay, this figure. Now from here we work backwards to get the total liabilities. So basically is with this figure 1383, put it here, you minus 200 minus 270, which is 200 and 270, give you 913k. From here 913k minus 510 taken from here and 350 taken from here, you give you 53,000. This is the plug figure. This is the positive figure, positive plug figure. This will be the external fund required. Any questions so far? Okay, moving on. How much, if any, additional financing will landed industries required in 20x2? Plug figure discussed. You know from the external funds required in the balance sheet is 53,000. Based on the forecast, the financial manager should arrange for a credit line of 53,000. Any questions so far? Could Landed Industries adjust its planned 20x3 dividends to avoid the situation described in B? Explain how. So basically you want to avoid the situation, okay, of going to require external funding. So what can you do to adjust the dividend? So if the dividends 20x3 dividends is reduced to 17k, the firm would not need any additional financing. So basically the firm do not need to borrow anymore. Need to get any external financing. Any questions so far?